The stock market is showing some cracks. The S&P 500 is down 8% and the Nasdaq has plunged 11% since February's peak. And with high valuations, persistent inflation, economic uncertainty, and a possible bubble in some tech stocks, some investors are worried that this could just be the beginning of a much bigger crash. But what if I told you that there's a strategy that's actually making money while the market sinks? A strategy that has historically outperformed during downturns and keeps paying you even when stocks are crashing. In this video, I'll break down exactly how it works, I'll show you 2 example portfolios, and I'll highlight the types of stocks that thrive when others fall. If you want stability and steady income, especially if you're retired and need your money to last, this is something you don't want to miss. As you might have guessed, I'm talking about a dividend growth strategy. It's really simple. You buy companies that not only pay a dividend, but regularly increase that dividend year after year. These are some of the strongest and most stable companies in America with typically very reliable cash flow streams. Think about giants like Coca-Cola, Johnson & Johnson, Procter & Gamble, companies that sell regular everyday goods used by people and businesses alike. When times get tough and uncertainty rises, investors want safety. I know we haven't seen that the last couple of years. Buying some of these slower growing mature dividend stocks has not been an exciting proposition when the market goes up about 25% back-to-back years. But when fear starts to enter the picture and people start to kind of worry more and want a little bit of safety, this is when a dividend growth strategy really shines. When stock prices are falling, these companies are pumping out regular growing dividends that can help you reduce or even eliminate the need to sell off parts of your portfolio in a downturn to fund your retirement. And most importantly, perhaps, they give you really great peace of mind. To illustrate that point, we're going to look at American Mutual Fund offered by Capital Group. Now, I'm not endorsing or recommending this fund, but it gives us a nice example of how this strategy has performed in real time, going all the way back to 1950 when the fund was launched. So it's lived through a number of big downturns in the market and the economy. Now, what does the American Mutual Fund do? Well, it invests primarily in well-established companies with strong balance sheets and a history of consistently paying dividends, helping to provide downside resilience. The fund holds about 170 stocks. These are pretty much all U.S. equities, mostly large cap, but also some mid cap stocks in there. From a performance perspective, dividend stocks have been out of favor. It's been a really rough several year stretch. Growth and momentum stocks have dominated the market. Companies like Nvidia, Meta have just soared and left a lot of these dividend stocks behind. You can kind of see that here with the American Mutual Fund. Over the last 5 years, the fund's total returns of about 12.7% have significantly trailed the S&P 500, which is compounded at about 16.9%. But when you zoom out, since 1950, the total returns are neck and neck. They're just generated in different ways. A defensive blue chip dividend growth strategy like this earns its keep when the tide goes out and investors want safety. I put together this chart here which shows the 16 years where the S&P 500 had a loss in blue, and I charted that next to the American Mutual Fund's total return. And I was honestly surprised to see that 15 out of those 16 down markets, the American Mutual Fund outperformed, in some cases very significantly. Like you look back here to when the tech bubble, the dot-com bubble popped after similarly strong years of back-to-back 20% plus returns in the late 90s in the S&P 500. The market then began to tank, and the American Mutual Fund actually was up 9% and 7% when the S&P 500 was down 9 and 12. I think we could see something like that happen again now if the tide does go out with how cheap some of these dividend spaces have gotten relative to the tech-heavy market. This year alone, we can see the American Mutual Fund is up about 2%, while the S&P 500 has lost 4% so far. Some people are worried about stagflation, high unemployment, bad economic growth with trade, tariff uncertainties coming up here. And during the early 70s through early 80s when this era happened, the American Mutual Fund did great. This blue chip dividend growth strategy was actually up 2% in 1977 and up 8% in 1981 when the market was down both of those years. During the big sell-offs in the early 70s, it also outperformed nicely as well. And you have to remember, this is an all-equity strategy. There's no bonds here, but a lot of these conservative dividend stocks kind of have bond-like qualities because they are reliable cash flow generators paying good income. So when investors worry about risk, it's kind of a flight to safety trade. that really helps buoy the returns. Now, being down 30% in the financial crisis still doesn't feel great. It's better than the market, but you also have to remember that you have dividend income continuing to roll in during those periods, which can help you, again, kind of ride them out and, importantly, have just peace of mind. So how does the American Mutual Fund do this? We'll head over to our website, simplysafedividends.com. You can track your dividend portfolio here. Check out our stock research, dividend safety scores for stocks and closed-end funds, screener, newsletter, all that stuff. It's free to try, 2-week trial, no credit card required or anything like that if you want to check it out. But I put the American Mutual Fund into a portfolio on our site. You can see the fund has about $100 billion in assets, throwing off a little over $2 billion in annual dividends. If you're an income investor, it's disappointing to see this low yield of about 2%. That's not going to get the job done in retirement, but it's coming from 170 holdings, and these are all pretty much household names. There's nothing, exotic here that's happening. It's a very simple approach. You have Microsoft, AbbVie, Apple, Broadcom, JP Morgan, Abbott, Accenture, Home Depot, just a lot of blue chip American businesses that are not going away anytime soon. A lot of these have exceptional credit ratings from S&P showing their financial strength and conservatism. Many of these businesses have increased their dividends for decades in a row. You can see Emerson Electric here at the top at almost a 70-year dividend growth streak. There's a couple dozen columns you can choose from in this portfolio tracker. You can move them around too to get the exact view you want of information on your holdings. One of the columns I put in was this recession return, which shows how each stock did during the financial crisis when the S&P 500 lost 55% from 07 to 09. You can see Fidelity National was actually up 8%, Gilead up 4%, McDonald's only down 3%, General Mills only down 12%. So these companies significantly outperformed the S&P 500, again reflecting the general resiliency of these dividend stocks when investors are fearful and want to basically fly to safe quality names that are paying reliable income during the storm. This strategy shines the brightest when that happens. The last thing I'll point out is, not surprisingly, most of these companies have very favorable dividend safety scores. If you're unfamiliar with dividend safety scores, we spend most of our time as analysts studying dividend risk across the companies in our coverage universe. Scores range from 0 to 100. Safe and very safe buckets are where a conservative income investor wants to hang out. We're the only company I'm aware of that maintains a public real-time track record of how our scores have done. So since we started doing this in 2015, investors who stuck with companies that scored above 60, so our safe and very safe buckets, they would have avoided at least 97% of the 869 dividend cuts that have occurred. We have a track record of all of those cuts explaining why they happened and our dividend safety score that was available before the cut to show their predicted value. From that lens, you can see the American Mutual Fund has about 80% of the dividends in its portfolio are coming from companies that have a safe or very safe rating, which is pretty solid and not a big surprise with their focus on these blue chip stocks. The portfolio's dividend growth has been decent, about 6% per year over time. That's just the organic dividend growth rate of these companies. It might not sound like a ton, but over the course of a decade, that's helped the dividends double from $1 billion to $2 billion over that time period. But for a 2% yield, that growth rate is not super impressive. If you actually pull up the mutual fund itself, here it is, you can see that the dividend growth history has not been amazing. There's a lot of volatility around the financial crisis, and the dividend growth rate is just not that high for such a low yielding fund. So that is a bit of a disappointment for sure for this type of product. But next, we will try and build our own dividend portfolio that has more current income, better dividend growth, and that same type of downside resiliency. I used our company screener to run a really simple search for businesses that are most likely to kind of hold up well when the tide goes out. So I'm looking at stocks that earn a safe or very safe dividend safety score, that have performed at least in line with or better than the S&P 500 during the financial crisis from a total return perspective. Latest dividend hike of at least 3%, so kind of keeping pace with inflation at a minimum, and have grown their dividends for at least 10 straight years. That gave me 171 matches, and the results table I sorted by dividend yield to focus on the highest yielding options first, trying to maximize current income. And I put in a few other helpful metrics to eyeball, like the 5-year dividend growth rate, S&P's credit rating, the recession return. So I just kind of spent a little time flipping through this list, jotting down stocks that looked interesting to me, both with kind of where they're trading at today and kind of delivering healthy levels of growth. And it all resulted in this portfolio, which I put together, called the Dividend Defender portfolio. 35 stocks. I like to equal weight my holdings. It's very hard to know which ones will be the best long-term performers. So each one is just under 3% of the portfolio here. And again, these are a lot of very common American businesses that you've probably heard of. Abbott Labs, Amgen, A.O. Smith, a water heater company, Chevron. So it's businesses that are very time-tested, generate a lot of great cash flow. And collectively, this $1 million portfolio yields about 3.4%. So about almost double the American mutual fund we looked at from a current income perspective. You could go with a higher yield than this even, but I wanted to kind of keep a good blend of growth. It really depends on what you're trying to accomplish. This portfolio's organic dividend growth rate has been about 6 to 7% pretty consistently over the past decade. So some very healthy long-term income growth with this collection of holdings. You can see that 100% of this portfolio's income is coming from safe and very safe rated stocks. So again, that's kind of a superior risk profile compared to the American Mutual Fund. Our sector mix does look quite different. None are greater than 20% of the portfolio. We have less tech exposure, which is kind of the cost to get that higher current income, but lots of defensive areas. Utilities, consumer staples, healthcare are some of our bigger weights that typically do well in a down market. And our income is really well spread out too. No stock is more than about 5% of the portfolio's income. When you couple that with the safe and very safe dividend safety scores we're focused on, it sets us up to hopefully ride out any downturn with our income stream intact and probably growing as well. Looking through the companies in the portfolio, you can see the lowest credit rating is BBB, so 2 steps above junk credit, and that's only 3 companies have that lower rating. We have a lot that are kind of in the A range. So very strong balance sheets in this group. The recession returns also, on average, these 35 stocks outperformed the S&P 500 during the financial crisis by 20% on average. So these companies have done it before. A lot of them are positioned, in my opinion, to do it again, just based off of their dividend safety scores, their credit ratings, their continued healthy dividend growth. And unlike the tech-heavy market, I'll add a column here for our valuation indicator. You know, a lot of these stocks look either undervalued or at least reasonably valued, whereas the S&P 500 is trading at north of 20 times earnings. That's historically high if you look back throughout history. A lot of dividend stocks remain like pretty almost cheap compared to the broader market, I would argue. One quick example of how this works, I'll look and pull up Chevron here, which today looks reasonably valued, CVX. But our valuation chart here shows that Chevron's stock price in gray has very consistently followed the stock's dividends. This blue bar is the price you would expect Chevron to trade at if it traded within 10% of its 5-year average dividend yield. Is kind of a proxy for the company's fair value over time that the market assigns it. So during the pandemic, Chevron crashed, but if you're looking at its dividend as a source of value for the company, the stock looks very cheap. Warren Buffett actually bought in around here, and sure enough, it recovered to that expected value line, actually jumped a little bit ahead of it, and it's kind of come back into that range today. A lot of stocks in this portfolio that I put together look pretty interesting today. Some of them even look quite cheap when you're kind of using that type of valuation framework. So I think there's low valuation risk to this portfolio, great fundamentals, low exposure if tech does start to unwind more, or if the economy heads south like the 2008 financial crisis. These are some great American companies that I think would hold up quite well for an investor with, again, that stable dividend income coming in and growing throughout that time as well. So dividends can be a great safe harbor when the waters out there get pretty rocky. And this is just one example of a portfolio you could create that I think would hold up well if history is any guide. I have no idea if the market will crash from here or if we could be setting the stage for a quick rebound. Your guess is as good as mine. I'm a long-term conservative investor, so these things that are out of my control don't really bother me a whole lot. I'm focused on building a stable portfolio that I can stick with in the thick and thin. And I think the higher volatility this year has shown a lot of retirees especially that big tech was a great ride on the way up, but man, when some of the rug gets pulled out of these high valued stocks and they fall 10, 20, 30% in a short period of time, you realize that type of volatility doesn't really perhaps align with your risk tolerance. Dividend stocks aren't really that way. I think that's part of their appeal, to be honest with you, that when times do get tough, when the markets are down, that's when these stocks really shine. That's when they typically generate their outperformance, hold their value a little bit better, keep delivering that predictable, steady income, which can be so crucial if we have a prolonged bear market at some point in the future. Now, there's lots of different ways to mitigate risk. I think dividend stocks are a great equity-focused approach to do so. If you want to check out this approach and explore it more, or if you have your own dividend portfolio and you want to see, hey, how risky does this look? I want some more defense ideas. You're more than welcome to give Simply Safe Dividends a try. It's completely free, our trial, no credit card required or anything like that. You can sync or upload your portfolio to get an immediate look at its dividend safety. We have lots of stock research and tools that are easy to use, fast, that can help you just make better informed decisions and be positioned to ride out whatever is ahead. If you enjoyed this video, it would really help my work if you considered liking it and even subscribing to our channel. I typically publish around 3 or 4 videos each month that are focused on income investing, dividend stock analysis, those types of topics. So thank you for watching if you made it this far, and I hope to see you next time.